$84 trillion. That's wealth sitting in American bank accounts right now, controlled by a generation that will be dead within 20 years. When they die, all of it moves to children and grandchildren who think about wealth completely differently. Every day, 10,000 Americans turn 65. Every day, billions change hands. The scale is rewriting American capitalism in ways most people haven't grasped. Boomers accumulated this during history's greatest economic expansion. They bought homes when mortgages cost less than a year's salary. They rode the S&P 500, delivering 15% annually. They compounded retirement accounts for 40 years. Now that mountain pours into millennials and Gen Z with fundamentally different views on work, money, and success, this is complete transfer of American economic power. We're watching birth of a new rentier class who didn't earn wealth through labor, but through birth. Housing faces 32 million properties potentially flooding supply. Financial services panics because 80% of heirs fire parents' advisors immediately. Capital flows from conservative bonds toward crypto, climate tech, and venture capital. But distribution isn't even. Top 10% receive the overwhelming majority. Bottom 50% share less than 1%. While headlines trumpet the transfer, most working Americans face different reality. No millions. Just medical debt and caring for aging parents whose healthcare consumed family equity. They watch peers become instant millionaires while grinding paycheck to paycheck. This is civilization's largest private capital movement happening now, reshaping markets and society. The question isn't whether this changes everything. It's whether we're prepared. To understand how we arrived here, we need to examine where this wealth was created. $84 trillion doesn't appear overnight. It compounds across decades. The foundation was laid after World War II. America emerged as the only industrial power with intact infrastructure. The GI Bill sent millions to college free. Suburbs sprawled with government-backed mortgages requiring almost nothing down. The stock market began climbing. Boomers were born into this. They entered the workforce during the 60s expansion, then rode the equity boom when the S&P delivered 15% annually for 2 decades. They bought homes when prices hadn't decoupled from wages. They maxed 401k contributions during history's longest bull market. At massive scale, their collective decisions moved markets. By the 2000s, boomers controlled half of all household wealth. Not through unique talent, but because they came of age when growth was abundant. They caught the wave at exactly the right moment. Now that wave crests, oldest boomers approach 80. Youngest hit early 60s. Over 20 years, this generation ages out of asset control through planned transfers, sudden deaths, or medical costs consuming everything. Cerulli Associates maps the trajectory. Of $84 trillion in motion, $73 trillion goes to heirs, $12 trillion to charity or taxes, $16 trillion moves within the next decade, creating what economists call a liquidity surge. About $15 trillion transfers horizontally first, spouse to spouse before reaching children. This creates a bridge generation of primarily older women as temporary wealth stewards. Their decisions ripple for decades. Real estate represents 30%, $25 trillion in property. Boomers own 32 million homes. As these change hands, heir decisions reshape American housing, sell in flood markets, convert to rentals, move in themselves. If you're seeing how massive this is, hit that like button. What comes next is where coverage misses complications. The financial advisory industry faces existential crisis. Data shows 80% of heirs fire parents' advisors immediately. It's generational. New wealth owners want digital platforms, ESG screening, crypto integration. This creates $20 trillion in musical chairs. Vanguard and Fidelity rebuild digital infrastructure. Traditional firms watch assets evaporate as rotation accelerates. But when wealth changes hands to recipients with fundamentally different values, nobody saw this coming. The public narrative says millennials and Gen Z are becoming the richest generations through inheritance. The data shows something more disturbing. While the headline is $84 trillion, distribution is so concentrated it creates 2 separate economic realities within the same generation. 60% of the transfer, $50 trillion, is controlled by the top 1%. Another 20% sits with the next 9%. 90% of Americans compete for $20 trillion, spread across tens of millions of families. The median inheritance is around $110,000. Not nothing, but nowhere near the millions dominating headlines. For a small segment of mostly coastal, college-educated heirs, the transfer represents genuine wealth. Enough for a home, business, early retirement. For everyone else, it covers student loans, helps with a down payment, provides temporary cushion. It won't fundamentally change economic trajectory. For the bottom half, there's often no inheritance at all, just the burden of caring for parents whose medical costs consumed everything. The healthcare industry positioned itself as the primary beneficiary. Long-term care costs $8,000 monthly. Memory care exceeds $15,000. A single nursing home stay drains hundreds of thousands before anyone dies. The industry optimized for extraction through complex billing, limited coverage, and family desperation. Several trillion of expected inheritance will divert directly into healthcare providers before heirs see anything. This creates the timing lottery. Families whose parents die quickly preserve wealth. Families whose parents decline slowly through chronic illness watch inheritance evaporate into medical bills. The randomness is brutal. Identical siblings end up in different economic classes purely based on how parents age. Heirs receiving substantial wealth make decisions unthinkable to parents. 1 in 3 younger inheritors plans 10% into cryptocurrency. They back climate tech, decentralized finance. Ventures traditional advisors never recommend. American capital orientation is shifting from safe, diversified portfolios toward higher risk, values-aligned strategies. This philosophical divergence causes family friction. Parents who built conservative blue-chip portfolios over 40 years watch children liquidate immediately to fund seemingly reckless ventures. The conflict isn't about money. It's about fundamentally different beliefs on how the world works and what wealth is for. Then there's the trust war. Wealthy families are in an arms race with the federal government over who controls this $84 trillion. Current estate tax exemption sits at $13.6 million per individual, shielding $27 million for couples. But exemptions are temporary, set to sunset soon. This triggered a stampede into defensive planning. Families established dynasty trusts in South Dakota and Nevada, allowing wealth to compound tax-free for centuries. They use complex structures to minimize exposure. This legal infrastructure creates permanent aristocracy, Americans whose wealth is insulated from taxation across generations. It's the opposite of meritocratic ideals. And it happens quietly in attorney offices while the public focuses on income tax debates. The federal government knows this. With national debt past $35 trillion in structural deficits, $84 trillion in private wealth looks like a target. Policy discussion centers on lowering exemptions, increasing rates, implementing wealth taxes for this transfer. The political battle is beginning. The outcome determines whether this stays private or becomes public revenue. What happens next determines whether this transfer cements inequality or creates opportunity. And the answer depends on decisions made right now in law offices and kitchens by people who don't realize they're shaping the economic landscape for 50 years. The $84 trillion isn't waiting in a vault. It's moving through the financial system now, reshaping capitalism in real time. Start with housing. Millennials were priced out for a decade, while wages stagnated and prices doubled. But there's a factor rarely discussed. The bank of mom and dad became the primary down payment source. Early inheritance, while parents live, fuels significant first-time purchases under 40. This creates hidden subsidy distorting the market. Identical incomes produce radically different housing outcomes based purely on whether parents have transferable wealth. Family capital buys homes, builds equity. Without it, people stay renting, falling further behind. The gap compounds invisibly. Same dynamic in entrepreneurship. 40% of heirs plan using inheritance to start businesses. That's trillions in private venture capital, but only for the right family background. Inherit $200,000 and you bootstrap, take risks, survive losses. Without that cushion, you're taking debt or giving equity just to start. Same idea, different outcomes, purely from inheritance. This creates a legacy economy where trajectory is determined not by effort, but by previous generations' planning. It's a fundamental shift from earned wealth supposedly defining American opportunity. By the mid-2030s peak, divergence between those who inherit and those who don't will be the primary driver of inequality. Now layer investment implications. $84 trillion sits in portfolios reflecting boomer risk tolerance. Bonds, large cap equities, REITs. As capital transfers to younger heirs, entire American private sector allocation shifts. Out of fixed income, into growth stocks, alternatives, crypto, private equity. This creates massive market-moving flows. When trillions rotate from bonds, yields adjust. When capital floods tech stocks or digital assets, valuations spike. The Fed watches carefully because it's monetary velocity they can't control. Private capital moving between generations, changing allocation, creating unpredictable price pressure. Family offices exploded over the past decade. Private investment firms managing individual family wealth. They used to be for the ultra-rich with hundreds of millions. Now they're standard for families with 20 million. These offices operate outside traditional wealth management, pulling capital from public markets into alternative structures. Think about this. If most American private wealth moves into vehicles invisible to regulators, what does that mean for market stability? For capitalism's functioning? Are we building efficient systems where capital flows to highest use? Or creating two-tiered economies where inherited wealth operates by different rules? This isn't abstract. This is the architecture of the next 50 years. This gets personal. Whether receiving inheritance or not, decisions made by this $84 trillion determine your cost of living, job prospects, retirement stability, and opportunities for your children. The transfer isn't just about people receiving money. It's about everyone inside an economy fundamentally restructured. In early 2026, we stand in the middle of history's largest private wealth transfer, watching it unfold in real time. Most people don't realize it's happening. The 84 trillion isn't future projection, it's present reality. Billions move monthly, portfolios shift, real estate changes hands, investment strategies pivot. The cumulative effect remakes American capitalism. The path forward isn't predetermined. There are inflection points where this goes in different directions. If inherited capital deploys into productive investments, infrastructure, innovation, technology solving real problems, we could see genuine economic renaissance. Entrepreneurship bursts, new companies emerge, solutions to climate change, healthcare, education funded by private capital moving faster than government spending. That's the optimistic scenario, and data suggests it's possible. Younger generations care about impact. They fund ventures addressing social problems. They think long-term beyond pure profit maximization. But there's another path. If capital gets consumed through lifestyle inflation, fragments across too many heirs to maintain scale, flees into offshore havens and non-productive assets, we face different outcomes. Widening inequality, calcified class structures, permanent divide between legacy wealthy and everyone else, and political instability when opportunity becomes purely inheritance-based rather than effort-driven. Government will play a role determining which path we take. Tax policy over the next decade is critical. Do we maintain generous estate exemptions allowing dynastic wealth to compound indefinitely? Do we increase taxation and redistribute portions into public goods? Do we incentivize impact investing or let market forces alone determine allocation? These aren't just technical policy questions. They're fundamental choices about what society we want to build. For individuals, the lesson is clear. Financial literacy is no longer optional. If expecting inheritance, you need to understand tax implications, investment options, estate planning structures before money arrives. Data shows sudden wealth syndrome is real. People inheriting large sums without preparation make catastrophic decisions in year one. They overspend, trust wrong advisors, fall victim to scams, trigger unnecessary tax liabilities. Education is the only defense. And if you're not expecting inheritance, that doesn't make this irrelevant. It means understanding the landscape you're operating in. You're competing for housing against people with family capital. You're competing for jobs in an economy where peers afford unpaid internships or start businesses without outside funding. You're navigating a system with hidden advantages you don't access. Knowing that doesn't solve the problem, but it clarifies the game board. It allows strategic choices with realistic expectations. The Great Wealth Transfer is ultimately a stress test for American capitalism. Can a market economy distribute resources fairly across generations? Can private wealth accumulation coexist with social mobility? Can we maintain meritocracy myths when birth increasingly determines outcomes? These aren't new questions, but the scale makes them unavoidable. 84 trillion forces us to confront them directly. We opened with a number too large for brains to process. 84 trillion. Now you understand what that represents. Not just wealth, but power. Not just money, but opportunity restructuring itself. Not just inheritance, but complete reordering of who controls American economic life for the next century. The transfer isn't happening in some distant future. It's happening now. 10,000 boomers turn 65 daily. Every day, billions move. Every day, the American economy's shape shifts slightly. Over years, those small shifts accumulate into something massive and irreversible. The question isn't whether 84 trillion will move. It's already moving. The question is what we do with that knowledge. Do we plan around it? Fight to make transfer more equitable? Build systems capturing portions for public benefit? Accept a legacy economy as new normal or resist it? Those choices are being made now in policy debates, family meetings, investment decisions across the country. Money doesn't lie. It flows where rules allow. Right now, rules are written by people who already have it, for people who will inherit it. Understanding that reality is the first step toward changing it, or if you're receiving, toward using it responsibly. The empire isn't falling, it's transferring. And the question isn't whether you'll be affected. It's whether you understand the game well enough to navigate what comes next. The 84 trillion has begun its journey. Make sure you know where you stand in its path.